Gen Zers and young millennials took out 40% of U.S. mortgages in 2023. Now, there were not a lot of mortgages done in 2023 relative to the years leading up to that, but
40% of those.
That's quite a bit. 2 in 5 new mortgages issued last year went to buyers under 35, and 27% went to buyers aged 35 to 44. Young people take out the majority of mortgages because they're of prime home buying age, gaining financial stability and growing families. Plus, they're less likely than older people to pay cash. Buyers under 35 took out nearly half of all new mortgages issued in Pittsburgh last year, the highest share of any major metro. 35 to 44-year-olds took out roughly 2 in 5 new mortgages issued in the Bay Area, the highest share of any major metro.
People still buying homes in San Francisco?
People, well, you know why? It's because people are selling homes in San Francisco.
Yeah, there you go. You're right.
Yes, people still live in homes in San Francisco. Sorry, San Francisco. We're not trying to step on you. But it was too easy. Okay, so lion's share of mortgages went to younger people last year. You see on the chart here on your screen that younger Americans are most likely to take out mortgages. You have under 35 reached 40% in 2023. And then 35 to 44, just, what was that, 27%?
Yeah.
I mean, that's a huge number. You're talking about, was that 67%? 2/3 of the homes are sold to people under 44, which, you know, I think is
the sweet spot.
Pretty much the sweet. Yeah, I was just gonna say. I was just gonna say sweet spot. That's the sweet spot. I mean, most of the people we see in here are under 44, and I would say most people who are over 44, there's something significant changing in their life. They got a brand new job that requires them to move, or they're moving up. They are maybe even also now at this point starting to take in a senior parent who might need help. They are also in the window where they might be having empty nesting happening soon, meaning, the kids are going to finish high school in a couple of years. We're going to move in that time, and we're going to go buy a new house. So it is of no surprise that as you get older in this chart here, there's less and less representation as far as who's taking out mortgages. And again, people who are in their older ages typically are trying to pay off their home, not have a mortgage at all, and then just live with only having to pay their taxes every month.
I mean, that's
insurance.
Beautiful. Yeah.
That's beautiful, right?
One of the things that I thought was, pretty interesting was that they actually quoted Redfin saying agents say younger buyers tend to be less faced than older generations by mortgage rates, and I think that's a characteristic I'm picking up on. A lot of the people that I'm talking to, just in general. I mean, a lot of the business that I do is for millennials and people that are under that 40 range, and what I am seeing is that they're more inclined towards being payment driven rather than rate driven. Mm-hmm. And if the payment makes sense, they're okay with the payment. The rate could be what it is. Although it still plays a huge part in it, you really can't do nothing about the rate. When you go buy a car, your credit is attached to your rate. So if you can work on your credit, that's going to give you the best chances. But I feel like that's kind of taking out of the play of now it's just well, if I can make the payment, the rate doesn't really matter because the payment's what I'm worried about. Down the line, you could have opportunities to refinance so that you could pay more towards the principal. But in the instance right now, I feel that people are looking at well, hey, we know the problem is shortage of inventory. So if things aren't getting better, which they haven't been for the last 2 years as far as the inventory crisis, then right now might be the only opportunity that I have to truly get into something to then later on have myself in a position where I'll be able to get to that property that I really want, because I'll be able to use it as a stepping stool to then utilize this to either rent it out, sell it for a profit, and then come in with that, big cash amounts that, you see other buyers, older buyers coming in with where they sold their house, they have, $300,000 cash from the property that they just sold, and they could put it all into that property. And right now, with the rates being so high, that down payment significantly brings the payment down to something where it's comfortable for them. Like, we have a client right now where they're selling their house. They're going to be netting $295K. They're buying for $865, and their payment's going to be, like $3,900. Mm-hmm. That for them is something that's comfortable. It's still a house that's, over $250,000 or $750,000. But that right there is the biggest thing that they bring that payment down, and they're okay with the payment. The rate's what it is. They're like, I'm worried about the payment. And if I can continue to make that every month, that's what my focus is. Mm-hmm.
Well, I think so. Great points there. A couple of things. First, you were mentioning how, maybe Gen Z and millennials are more focused on the monthly payment than the interest rate. I think there's definitely something to that. I mean, for now, most of your adult life, things have been broken down into monthly payments, and it's not as much about the rate. It could be the car lease or the car payment, the car loan. It's, the newest phone came out. the payment is $40 a month or $30 a month.
Exactly.
It's just what's the subscription payment for this service or that service and entertainment and all that. So kind of I'll say subscription model consumerism I think is maybe kind of emerging with the idea of just what's the payment. I'm not as interested in the rate. And you also said at the top of the segment something that was interesting is that they're less phased.
Yeah,
they're saying that in the article. But here's what's funny is as you get older in the graph, they're also less phased by the rate. You know why? Because they owned a house when it was 13 or 16, and now it's 7. Like 7? Why y'all complain about 7?
Jeez.
Because they're on the other side of the unfazed argument, which is, when it came down to 11, I refinanced right away.
and I really feel it's for
that sounds crazy.
And the people that bought houses or were aware of the market when rates tanked. I think those are the people that hold the most rates are so high now because they compare it to that, and that's the only example that they could utilize in real life to say, hey, well, that's what I can compare what rates are and what I wish they would be. But again, that was a weird time. It was very artificial, and it was only short-lived. Unfortunately, we're back to what is what average is, and I believe the average rate, don't quote me, is anywhere between 7-8% in the last 50 years. So we're basically right where average rate is for the last 50 years since they've been taking account of for rates.
Yeah, and I think again part of the way that these numbers are looking, it's the result of people being creative in how they're buying homes. It's me and my friend are going to go do this, or me and a couple friends are going to do that. I'm going to use a family member who's going to buy this with me, or my the person that my significant other that I'm not married to yet, but we are eventually be married or whatever. Like they're making that commitment to ownership. And I know that there's a lot of speculation about corporate ownership of homes in the United States right now, and why are all these rich people buying farmland, and then how come all these corporations are buying up neighborhoods, and there is something to that. I'm not going to sit here and pretend like it's not happening. It's freaking happening. At the same time, I'm not going to sit here and pretend like I know why they're doing it. I can assume why they're doing it. I can assume what they're going to do over the course of time. You will own nothing and be happy.
I mean, it comes down to basic necessities, and the people that are playing on these big realms of buying up all this land, understand that you need water and you need shelter, and if you're able to capitalize on those, there's only so much land we could build on. So the more that they buy up, unfortunately, but
it's not just the building of the land. It's how that land's held. Is it I'm building 1,000 rentals, or I'm building 1,000 units that someone can buy? If I go build 1,000 rentals, I'm not intending to sell them. I'm intending to rent them. So I think that's part of the what I'm saying. I'm lightly tap dancing around the skepticism of speculation of why that's happening. But it's for control is what it really is. And so I think that the millennial and Gen Zers who are also seeing that, and whose BS meter frankly is very high, and can go, I see that's a crap sandwich from a mile away. I'm going to fix my own situation now, or get my own house in order, or whatever you want to, however you want to say it, to phrase it, to say that's what they're doing. That's what they're doing. That's what the numbers are showing. They're saying, hey, I'm going to miss out on this, and unless I do something now, so even if it costs me a higher rate, if I have to do it with somebody else, I got to get money from a family member who's willing to help with a down payment. I mean, we've talked about these things time and time again, and they're just doing it. And as much as people want to hate and say, hey, that's stupid, you shouldn't do this, you shouldn't do that, there's risk in any market. There's risk in a high market. 100%. There's risk in a down market. There's risk in a sideways market by waiting, and there's risk by participating. And the difference is, what rewards are you reaping on the other side of whatever time you're afraid of?
100%. I mean, it's all in the opportunities if you decide to take it or not. And I feel like when they present themselves, the data shows that they're taking them.
Yeah, 100%. And even I dropped this kind of in that little diatribe there, but talking about millennials and Gen Zs taking financial help from a family, and that's exactly what it is. And I think it's also because there's culturally part of that, hey, we're seeing the same thing. I'm not saying that all families agree and they're just homogenous and no one has any difference of opinion or, cultural perspective. But, even in my own family for, multiple generations, it's a generation ahead of me, a generation behind me. And we all agree, it's better to own than it is to rent.
Right.
And so however we can foster that into the next generation, we're going to do that. And so that is the goal, regardless of whatever opinion we have about the specific topic or of housing and corporate ownership and that kind of stuff. I think the goal is to get people to own homes.
It's not a one size fits all. Everybody's case by case. So, some gonna have great experiences, some unfortunately didn't. But, it's not for you to say, hey, don't go buy a house. Go experience it for yourself and just, do the research and just, Get educated more than anything.
Other thing too, I want to mention this before we go on, is that depending on where you're at in the country watching this, it does change what percentage of your generation is the owner there. I mean, even in the article it's citing Florida. Well, okay, in Florida, we all know Florida is a retirement haven for a number of reasons. Same thing for Arizona.
Yeah,
and Nevada's kind of getting that way too. There's a lot of people going to Nevada because there's it's affordable. It's hot during the winter. You're not gonna deal with snow.
Yeah,
in most of it. So there are pockets where what it looks like to you is going to look very much different based on where you are in the country and how many of your own generation are owners versus renters. So just take that note as we close out this part of the show.
Nice.
Brian, we are going to talk about the third article today. It is the decision to sell your home versus rent it out is, quote, complicated, experts say. I don't think it's always complicated. I don't think it's complicated for a number of reasons. I understand why they're arguing that it might be complicated, but let's give some of the details of the article first, and then we can talk about it, okay? Roughly 6 in 10 existing fixed-rate U.S. mortgage holders had an interest rate below 4% during the fourth quarter of 2023. We already know what this is. This is the golden handcuffs we talked about ad nauseum from people refinancing in 2020, 21, and the first part of 2022 before the Fed started raising rates in March, which then, of course, cascades into the mortgage market and mortgage-backed security market also raising rates. So there is that.